Hello, everybody. Welcome to our webinar. Today, we have a presentation from Carlson Quinn. Carlson Quinn and Strongpoint Partners are proud to host this exclusive webinar about employee stock ownership plans. Today's presentation is led by Leif Carlson, co-founder and president of Carlson Quinn. Leif brings extensive experience in the retirement consulting industry, working with a wide range of clients from sole proprietors and professional service firms to partnerships and mid-sized businesses. He offers strategic guidance and ongoing consulting for an array of plans. He has an extensive experience in the development and administration of ESOPs and stock-based compensation plans. And with that, I will hand it over to Leif Carlson to share some background on Carlson Quinn.
Welcome, everyone, and good afternoon. For any of you who are joining us from the state of Hawaii, good morning. Again, and thank you for the introduction, Savannah. Again, I'm Leif Carlson, and I am a principal and co-founder of Carlson Quinn. Carlson Quinn is a strategic retirement plan consulting and administrative firm based in Northern California. Actually in the Bay Area of California, just east of San Francisco, in Walnut Creek, California. And we were founded, the firm was co-founded by myself and Brian Quinn in 1994. So we've been in business now for well over 30 years, lots of experience. And we we became a partner in Strongpoint Partners effective in early 2024. And our motivation at the time was primarily twofold. First, we wanted to ensure continuity for both our clients and for our employees. And second, we saw this as an opportunity to actually enhance our client services delivery by leveraging off of the infrastructure and deep resources and expertise of a national organization. Carlson Quinn was partner number 7 in early 2024. Strongpoint Partners now consists of, I believe, 24 partners as of today. And our reach extends over 6, perhaps 7 time zones, reaching from the far reaches of New England to all the way to the state of Hawaii. So each one of the firms within Strongpoint Partner have a special expertise or certain expertise that they are able to share with the other partners within the Strongpoint Partner organization. So we all work with one another in that regard in delivering services to our clients. So each of the partners has their own special expertise. A lot of overlap. Of course, we're all retirement plan consulting firms. Carlson Quinn specifically works with a lot of clients that have complex needs, sophisticated plan designs. We provide services along a broad spectrum of retirement plans, both qualified and non-qualified. So our offerings include, of course, 401k, 403b, 457 plans, cash balance, defined benefit, profit sharing, runs the whole gamut, along with non-qualified deferred compensation plans, and of course, ESOPs, which is the focus of our conversation today, employee stock ownership plans. So that's kind of an overview of Carlson Quinn. I think with regard to the attendees of this webinar, and those who may be listening to this in the future, as it is being recorded, I think what I'm hoping you take away from this is a better appreciation or understanding of what ESOPs are, and so that you may be able to identify when you talk, particularly for an advisor, talk to one of your clients, and see whether they may be a good candidate. So again, today's focus, we want to talk about several things. There will be an opportunity at the end to ask questions. You may want to jot down questions as we go so you don't forget. But we will be talking about what is an ESOP, why you would establish or might want to establish one. We'll talk about leveraged versus non-leveraged ESOPs. ESOPs are a very unique animal because you're able to actually leverage them, unlike other qualified plans. Tax benefits to selling shareholders, S Corp considerations and compliance testing associated with S Corps, deduction limits, of course, benefits that these plans offer to employees and employers alike. We'll talk about a put option because most ESOPs sponsored today are comprise closely held stock. So really the only market for that stock is the employer itself, which brings up the concept of a put option. Diversification rules, you don't want to put all your eggs in one basket. And then we'll discuss some of the significant considerations for ESOPs that include repurchase liability, understanding, feasibility analysis on the front end, and other considerations. Implementation, questions that you might want to ask, to see whether or not you have a candidate that or a potential candidate, and then a live Q&A. So with that, we can turn to the next slide. So what really is an employee stock ownership plan? An employee stock ownership plan is a type of defined contribution plan, like a 401k or profit sharing, but it's a very specialized defined contribution plan that invests primarily, in fact, is required to invest primarily in employer securities, and it combines the elements of corporate finance, succession planning, and employee ownership. So there are a lot of different ways that employee ownership plans or ESOPs can be utilized. ESOPs actually have a long history. I mean, a lot of people or plan sponsors, companies may not be all that familiar with them, but they actually go back a long way. The first ESOP, although it wasn't called that at the time, was invented, if you will, back in 1956 by an attorney and economist, Louis Kelso. And he was approached by a couple of old, aging stock owners or owners of a company, Peninsula Newspapers, based out of Palo Alto, California. And they had a dilemma. They were in their early 80s, and they had built a very profitable company. They had built a culture that they were very proud of. They viewed their employees like family. They also were, they understood that they couldn't live forever. And again, they were in their early 80s. So they wanted to transfer the ownership in some way to employees. Now, the employees really weren't in a position necessarily to buy the stock directly, or were not necessarily inclined to borrow. And so they approached Louis Kelso, and Louis Kelso looked at this and he came up with an ingenious idea. And he says, well, you have a profit sharing plan. Why don't you, have the profit sharing plan actually borrow money to buy your stock and then pay back the loan over time out of future profits on a tax advantage basis. And of course, that was a brilliant idea, but nobody had ever thought about it before. So that was the birth of the ESOP. And ESOPs gained further traction. Well, actually, they weren't formalized until or codified until 1974 with ERISA, and then in the early 1980s, they gained further traction with particularly the advent of Section 1042 of the IRS code, which allowed selling shareholders, and we'll talk about that in a bit, allowed selling shareholders to actually cash out and defer the tax on their capital gain, potentially indefinitely. And then in the late 1990s, S Corps, the legislation was passed that allowed ESOPs to actually own stock of S corporations. So, today, probably between 5,500 and 6,000 ESOPs are sponsored in the United States, covering probably 14 to 15 million participants with up to, or as much as, if not in excess, of $2 trillion. So most ESOPs are Closely held, probably over 90% of them are closely held. The other 10% or fewer than 10% are publicly traded. But we're primarily going to be focusing on closely held ESOPs today. So with that having been said, employee stock ownership plans are established with one or more goals in mind. They may hold, we're still on the former slide. Oh, yeah, just stay right there. We're fine. So they may hold either closely held stock or publicly traded stock. First and foremost, ESOPs, or an ESOP is a qualified plan, an employee benefit that transfers all or a portion of a company's ownership to employees. And by owning a part of the company, employees then have a stake in the business and are therefore likely to be more efficient, look for ways to increase the efficiency of the organization, new ways of doing things, because they're all on the same team and their shares are their interests are aligned with management, shareholders, and of course other employees. So, they're looking for ways to increase underlying value to the company. This then translates to increases in share value, which in turn translates to more retirement income if they are participating in an ESOP where they're allocated stock. ESOPs may also be used as a tax-efficient means for succession planning. So, this is something that a lot of owners of closely held businesses that may have founded their business many decades ago, and they struggle with how do they, exit. What's their exit strategy? If they go ahead and sell to an unknown buyer, that unknown buyer may destroy the culture. That unknown buyer may destroy the company, right? So submit to a hostile takeover, going public, those aren't necessarily all that attractive. So an ESOP becomes another avenue where they can exit their company and realize the fruits of their many years of hard work and the substantial unrealized appreciation in their stock. Finally, ESOPs may be used as a tool of corporate finance. So it's a way to raise capital on a tax advantage basis, because unlike a typical loan that has, you may be able to deduct the interest, with an ESOP, you can deduct the interest and the principal as well. Just final comment before we move to the next slide is that even though there are a lot of advantages to ESOPs, they need to, if a client or a sponsor is considering one, they want to go in with their eyes open. They're somewhat more complex than a typical plan, a lot of rules and requirements. So you do want to work with an experienced, group of consultants, an ESOP attorney, accountants, and so forth. So with that, let's move to the next slide. And this is just kind of a reiteration of a lot of what I already had mentioned. So many companies may benefit from the establishment of an ESOP. A lot of attractions. Succession planning is a big one. For owners that are looking for alternatives to selling to an unknown buyer, submitting to a hostile takeover, or trying to sell the shares directly. It allows the employees to have a stake in the business and its future growth. The operative word here is empowerment. You empower the employees to drive growth in your company, drive profitability. Tax efficient way for company founders to cash out. The government thinks that these are ESOPs are a good idea. So there are incentives for company founders to cash out on a tax advantage basis. Tool of corporate finance, means to raise capital on tax favored basis. Potential for significant increases in retirement savings, and benefits for the employees, the company, and selling shareholders. All their interests are aligned with an ESOP. Moving to the next slide. Leverage versus a non-leveraged ESOP. With a non-leveraged ESOP, so leverage essentially means that there's just a loan involved. There's a loan being made to the ESOP. So with a non-leveraged ESOP, there is no loan. I mean, essentially, the way that works is that the company may contribute treasury stock. So there's no initial cash outlay. They contribute treasury stock or newly issued shares to the ESOP, and then those shares are allocated to participants, typically in proportion to compensation, although there could be other ways that that stock may be allocated. You could allocate it on service. You could allocate it just, the same dollar amount to participants in proportion to compensation, some combination, but typically it's allocated in proportion to comp. The beauty of this is that since the contributions of stock are tax deductible, this means that companies get a current cash flow advantage by contributing treasury stock to the ESOP because there's no cash outlay, but they get the deduction. And that allows the company to have more money in its coffers to invest, acquire other companies, and further build the company and add to profitability. The one note there, of course, is that if you contribute treasury stock, now you have more outstanding shares, so it will result, at least initially, in a dilution of the company's outstanding shares. However, that is, ordinarily more than made up for by the empowerment to employees and increased profitability. Now, with a leveraged ESOP, ordinarily, that's where a loan is involved. So a loan may be made to the ESOP directly to purchase stock, or it may be made to the company, and then the company makes a mirror loan back to the ESOP. But in either case, you have a leveraged transaction. Ordinarily, under Code Section 4975, that's considered to be a prohibited transaction. With an ESOP, there's an exception under, I think it's D3 of Section 4975 that says that you can make a loan to an ESOP is exempt from the prohibited transaction violation if, in fact, it is primarily for the benefit of participants and beneficiaries, and secondarily, it bears a reasonable rate of interest, and any collateral given to disqualified persons, that being the company or our original shareholders, the only collateral is the qualifying employer securities. The way this works then is that once the loan is made to the trust, contributions are made that are sufficient to make the loan payments. The stock that was actually purchased is held as collateral against the loan, and as the company makes contributions from future profits to the plan, then that stock is released, typically in proportion to principal payments, could be principal and interest, but a percentage of the shares are released each year and then allocated to participant accounts. With respect to the 415 annual edition, that actually may be a function of the actual cash contribution, not the current value of the stock. So the actual value of the contribution may be significantly higher if the shares have increased in value. Having said that, typically when you have a loan being made to an ESOP, the value of the stock immediately after the transaction drops because now the company has a liability that it didn't have previously. And so there is initially a drop in the share price, and then that share price is recouped as the loan is repaid, and many times, in many instances, by much more. So because of that, there is the opportunity to actually have the 415 annual edition amount be determined by the actual value of the allocated stock in the early years, and may be beneficial in the early years when the value of the stock hasn't recouped its entire original value. So that's a non-leveraged and a leveraged ESOP. Now, if we turn to the next page, this is where, yeah, so those people that may be more visually inclined and may not have followed everything that I was saying, this is a nice little schematic that actually shows the different parties involved with a leveraged transaction, which of course would be in the upper left-hand corner, the bank or the lending institution. The company in the upper right, of course. In the middle is the ESOP trust or the plan. Then you've got the participants or the employees. You may have original shareholders, and then something that we call qualified replacement securities, which we will talk about in just a moment. That allows for the tax-advantaged sale of shareholders, original shareholder stock to the ESOP. So if you look at the schematic, you can see with the bank, and I think I had mentioned earlier that the loan can either be made directly to the ESOP trust, or it could be made to the company, and then the company makes a mirror loan to the ESOP trust. In either case, of course, the bank is going to require a guarantee from the company, because even if they make the loan directly to the ESOP trust can't generate money on its own, so it needs to be backed by a company guarantee. In this schematic, we're showing the loan from the bank going directly to the ESOP trust. So you can see on that left-hand side, the arrow showing a dollar loan going into the ESOP trust. So now the ESOP trust holds cash, and they use that money then. The loan proceeds go either to the company in exchange for treasury stock that then flows into the ESOP, or alternatively, the proceeds go to the original shareholders who exchange their holdings, which are then held in the ESOP trust and held. In either case, the shares are exchanged for cash and the shares are held as collateral. Then the company, you can see the annual contributions on the upper right there. Company makes annual contributions to the ESOP trust, sufficient to make the loan payment. The loan repayment then goes back to the bank, and in accordance with the formula, a percentage of the shares that were originally held as collateral are released, and they get allocated to participant accounts, typically in proportion to pay. Now, at the bottom there, you see the original shareholders, where they can actually purchase qualified replacement securities under Code Section 1042. So let's turn to the next slide and discuss what that means, the benefits that a 1042 transaction or exclusion can provide. These are tax benefits to the selling shareholders. So a lot of these selling shareholders are closely held stock. They may have invested, a few $100s as seed money in their company decades ago, and now they're holding stock that's worth many millions. Well, there's a huge capital gain there. So if they actually sell to an unknown outside buyer, they're going to have to pay immediate tax on that capital gain. A lot of them don't like that idea. So, as a matter of public policy, the government thinks ESOPs and employee ownership is a good idea for the macroeconomy. And so they have provided certain tax incentives to incentivize employers and selling shareholders alike. What Section 1042 allows is for owners of closely held stock of a C corporation. Now, a Secure Act, this is available, but only marginally, to S corporations as well, although I think only it begins in 2028. But this is primarily a C corp consideration. So 1042 passed with tax reform in the early 1980s, allows owners of closely held stock to sell their stock to an ESOP and defer the tax on the capital gain, potentially indefinitely, which actually sounds like a pretty good deal, providing that certain conditions are met. So, what are the conditions? The ESOP must own at least 30% of the outstanding stock immediately after the date of the acquisition. So the selling shareholders have to sell at least 30% of their stock to be able to take advantage of this. Moving on to the next slide. The selling shareholder then must buy with those proceeds what is called qualified replacement property within a 15-month period, which begins 3 months prior to the acquisition and ending 12 months thereafter. The stock must have been held by the selling shareholders for at least 3 years prior to the transaction. And qualified replacement property means any security issued by a domestic operating corporation. So, you can take those proceeds and buy X number of shares of Apple or Google or whatever. The beauty of this, the unrealized gain then is only recognized upon sale of that replacement property. The beauty of this is that if the replacement property then that you purchased is passed on at death, the heirs may receive a stepped up basis. So now you think back to these owners, these original shareholders, they seeded the company with a few $100s. They walk away with 10 million. And there's no capital gain tax potentially on that entire $10 million. So significant advantages to selling shareholders. Moving to the next slide. Okay, so S-corps. S-corps are a little bit different. And in fact, the IRS didn't even allow ESOPs to own S-corp stock until the early 2000s. And the reason was because they saw that there was potential for significant abuse with an S-corp entity, because an S-corp entity is a pass-through entity, of course. Well, first off, I just wanted to side note here. The owners of an S-corp may only defer tax on up to 10% of the unrealized appreciation under 1042, and that's through Secure Act. But other significant advantages to the S-corp. It's a pass-through entity, and this is what the IRS was concerned about. An S-corp, if you think about it, an S-corp that is wholly owned by an ESOP, so the ESOP owns the S-corp in its entirety, 100%, pays no tax. Because the corporate profit or loss each year passes directly through to the ESOP, 100%, which is a tax-exempt entity. Each one of the shareholders of an S-corp receives a K-1 at the end of the year, showing their share of the corporate profit or loss. So that could be pretty significant. And if you are able to pass that through to a tax-exempt entity and pay no tax, well, that gives you an incentive, particularly with family-owned businesses, to say, well, boy, that's a great idea. Maybe if I just have all my family members work for the work for the company, then nobody pays any tax. And so that was a concern. The IRS came up with a special test, which we'll talk about in a moment, to address that matter. But the other interesting thing about an S-corp, because again, everything is passed through to the shareholders. Well, in the event that you have outside shareholders, but the S-corps don't pay dividends. The concept really doesn't exist. They typically make what is called a sub-S distribution. And so if there are outside shareholders and then the ESOP owns a certain percentage of the company, typically an S-corp will make a sub-S distribution, which is just a return of capital, to all its shareholders, including the ESOP, that's sufficient to cover the expected tax liability incurred by the outside shareholder. So if the outside shareholder is receiving a K-1, and the company is highly profitable, they have to show a profit or earnings on their tax return, and they don't necessarily have the cash to pay the tax. So an S-corp, typically to address this, will make a sub-S distribution, which reduces the cost basis of the stock, of the actual stock. But by so doing, the outside shareholders now have money in their pocket to pay the tax. But since S corporations can only have one class of stock, if you make a sub-S distribution, you have to make it pro rata on all shares. So what happens, particularly with a highly profitable company that's in this situation, they may be passing through significant profit. And that has to be passed through pro rata on all shares. So it kind of like looks like a dividend, but it could be, as much as 20 or 30% of the underlying share value or more, depending upon how profitable the company is. And that then, with respect to the shares that are held by the ESOP, is passed through to the ESOP held shares, which of course are allocated to plan participants. And they see not only an appreciation of the underlying stock, but they could see a 20 or 30% or more additional allocation to their account, which can significantly increase retirement savings within the ESOP. So very interesting thing about S Corps. Moving on. This gets to the prohibited allocation. So in the late 1990s, the IRS came up with a rule that would allow S Corps to actually sponsor an ESOP, which they were prohibited from doing previously. So essentially what the IRS wants to see is that there's broad participation within the ESOP. It's not just family members. And this is a very, very important test because unlike tests, other compliance tests within the retirement plan world, there are corrective measures. There's something that you can do to correct an inadvertent error or error. In this case, if you violate 409P, there is no effective correction. I mean, effectively, you're dead in the water, which is a really, really bad thing. So this is one of the considerations when a company is thinking, or an S Corp is thinking about establishing an ESOP, is part of the upfront feasibility analysis to ensure that you're not going to run afoul of this test. How does the test work? Well, it defines a non-allocation year. A non-allocation year is a year in which disqualified persons in aggregate own at least 50% of the number of shares of the S Corp. A disqualified person is anyone whose deemed owned shares equal at least 10% of the number of shares of the S Corp, or, and here's the kicker, at least 20% when combined with family members. Who are family members? Spouse, lineal ascendants and descendants, siblings and spouses of siblings. So they pretty much capture or cast a wide net here. You also have to consider synthetic equity. So what is synthetic equity? Those are effectively stock options. So this test must be performed and pass with and without consideration of that synthetic equity. So by doing this, the IRS determined that, well, if you pass this test, then it is deemed to be, or the participation is believed to be broadly shared. It's not just family members. Now, what happens if you fail? This is where it gets ugly. Immediate distribution of the entire account of each disqualified person, immediate taxation, penalties if you're under age 59 and a half, and to boot a 50% excise tax to the S Corp, as well as loss of ESOP status and S Corp status. Very, very, very bad news. But this is where you rely upon the expertise of your advisors and ensure that this is not going to be a problem for your plan. So again, part of the whole feasibility analysis on the front end. Moving on. Okay, so let's talk about deduction limits for a bit here. Ordinarily, with ESOPs, they are a defined contribution plan, so they have to be combined with other defined contribution plans that are sponsored by a single employer, and you have to consider the allocations that are made among all of those defined contribution plans. The limit, this is for C Corps only. I mean, S Corps is is a different story because of the pass-through income component. But the ordinary limit for one or more defined contribution plans is up to an additional is 25% of covered payroll, and that's under Code Section 404A3. In addition, there's a separate code section that is specific to ESOPs, leveraged ESOPs, that allows up to an additional 25% of ESOP covered payroll for repayment of principal if you have an exempt loan that has been made to or through the ESOP. Applies just to C corporations. So really between the two there, where the ordinary limit is 25%, you can get as much as 50% or even more if you consider that beyond 25% is deductible as well, to the extent that it represents an interest expense on a leveraged transaction. With the S Corp, again, it's a pass-through income. You have pass-through income there to a tax-exempt entity. So 100% S Corp owned ESOP pays no tax. There's no tax implication. I mean, if the ESOP owns 100% of the shares, there is no tax on the corporate level. So that, is a huge benefit, of course, for S corporations. Cash dividends, and again, cash dividends really only apply to C corps because the concept doesn't exist with an S corp. They make sub-S distributions, but cash dividends for an ESOP, for a C corp, cash dividends on ESOP stock may be deductible as well if they're used to pay down an exempt loan or if they are passed through directly to participants. Moving on. Of course, there are benefits to the employees as well, which includes, special rules associated with the 415 limits, which are, the maximum annual addition or annual allocation that may be made on behalf of any one plan participant when in consideration of all plans maintained by a single employer. Well, first and foremost, as we've already discussed, a huge benefit to the employees is employee empowerment and ownership. And the whole idea here is that with employees having a stake in the business, their interests are aligned with management, shareholders, their fellow employees. They all play for the same team. And that right there provides incentive to look for ways to increase the profitability of the company, which benefits then at the end everyone. The 415 limit among all defined contribution plans, which include the ESOP, currently 2026 is the lesser of 72,000 or 100% of compensation. With a leveraged transaction, and I touched upon this a little bit earlier, it's a function, or it may be a function of the cash contribution. The stock, of course, is released according to a formula as the loan is repaid. So that can actually result in, if the share price has appreciated materially, you could actually get an allocation to your account that is well in excess of the ordinary $72,000. Or, of course, if elected, the actual value of the allocated stock. And we talked about that earlier, where if in the early years of the acquisition loan, the value of the stock, may not have fully recovered to its pre-transaction price, which would mean that probably would be better to just use the cash contribution when determining 415 maximums. Dividends generally and/or sub-S distributions are not considered to be annual additions. So again, those sub-S distributions that I said with a highly profitable company can be very significant. That's just free money, as they are not considered annual additions. Moving on to the next slide. Tax benefits to the employer. So as I had mentioned earlier, the difference between a traditional loan and an ESOP loan, or a loan made through an ESOP. With a traditional loan, a company can borrow money from a bank, and then as they repay the loan, they may be able to deduct the interest, but not the principal. The ESOP loan, by making a loan through an ESOP and paying back the loan through the ESOP, not only does the company get to deduct the interest payments as they would with a traditional loan, but they get to deduct the principal payments as well. So if you look at the actual cost, I mean, this is just illustrative of a $5 million loan. And you look at the assumptions at the bottom. So 2 and 3 are kind of the material assumptions. 30% corporate tax rate, that would be, between federal and state. If you assume a 12% loan rate, you can see what the cost and the after-tax cost is for each year. If you repay that back, just equal principal payments. So for instance, in year 1 there in a traditional loan, well, the cost is the after-tax cost, of course, is the principal and the interest, and then you get a tax savings on the interest, which is the marginal tax rate times the interest payment, which in this case is $180,000. So the after-tax cost in year 1 is $1,170,000. So you just apply that, across the 7 years, compare that to the ESOP loan. So the tax savings element is not only on the interest, but the principal. So in year 1, $750,000 plus $600,000, that $1,350,000 multiplied by the marginal tax rate of 30%, that's $405,000. The after-tax cost is the principal, the interest, minus the tax savings. So you can see the difference of the after-tax cost in this illustration between the traditional loan, the ESOP loan, and when you add it all up, the difference in the after-tax cost is $1.5 million. So that's an extra $1.5 million that the company has in its coffers that can be used to acquire other companies, invest for future profitability and so forth. So a significant tax benefit to the employer as well. Next slide. When must ESOP distributions begin? So the IRS recognizes that ESOP distributions, or with closely held companies, the market for the stock is really the company itself. And so they have special rules in terms of being able to extend the time frame over which distributions are required to begin. So the general rule is not later than 1 year after the close of the plan year in which the participant retires, becomes disabled, or dies, or no later than the 6th plan year following the close of the plan year in which the participant separates from service for reasons other than death, disability, retirement. So this gives the company an opportunity to, a time frame, a longer time frame over which, they need to buy back that stock. And then once they begin, the distributions must be made over no more than 5 years, up to an additional 5 years for large account balances. So somebody who terminates from service, may have to, their distribution, depending upon how large their account balance is, may extend over 15 or 16 years. So it gives a lot of time for the company to actually plan for the redemption of this stock. Next slide. The put option. So again, this really applies to C corporations, but this is a right to sell at a certain price. So with an ESOP, participants can actually demand that they receive their account balance in the form of stock. Well, I mean, that's all fine and dandy, except if you hold the stock, and if you can't readily sell it on a readily tradable market. So you may just have to hang on to it for an extended period of time. So there are rules associated with individuals who request their distribution in the form of stock. They have a right, I mean, the company needs to grant them a put option. So the right to sell at a set price. And that put option has two windows, two opportunities wherein that stock can be put back to the company. The first one is within at least 60 days following the stock distribution, or if they miss that, during a 60-day period in the following plan year. Now, if they miss those two options, those two windows, then they're just holding the stock. And there may not be easy ways to dispose of that. So they just may hold stock that has a lot of apparent value, but they can't realize, any liquidity from that. It will be very difficult. If it's put back to the employer must repurchase that stock in substantially equal period payments, beginning within 30 days after the exercise of the put option, over a period not to exceed 5 years, and they must provide security and reasonable interest. Again, with S corporations, S corporations, ordinarily there's an exception. So they can deny distributing the account balance in the form of stock, and they can just distribute in cash. And they often do, because with an S corp, I think now you can just have 100 participants or somewhere around there, or shareholders with an S corp. So you don't want a whole bunch of people, hanging on to stock outside of the S corp. So let's move on from this. That's the put option. Diversification, again, you don't want to have all your eggs in one basket. And the IRS, the law recognizes this, and so they provide rules wherein participants who are nearing retirement have an opportunity to diversify out of their stock holdings. A qualified participant is anyone who is age 55 with 10 years of participation. Qualified election period is a 6-year period. During the first 5 years, you can diversify up to 25% of your stock holdings, and then up to an additional 25%, so 50% in total in the last plan year. And the ESOP, in order to satisfy the diversification requirement, the ESOP must offer at least 3 investment options within the ESOP, or as they more typically do, is just to distribute or transfer to another qualified plan. Now, if you are a participant eligible for diversification and receive a distribution of your diversified holdings, and if you're transferring it to another qualified plan, say a 401k plan sponsored by the same employer that allows you to invest in company stock, the recommendation is don't put it right back into company stock. Kind of defeats the purpose. And I've seen that happen. That's why I bring it up. Feasibility. So here we talk about feasibility and repurchase liability considerations. As I had suggested or mentioned early on, it's very important that companies that are considering the implementation of an ESOP, that they go in with their eyes open. There are tremendous advantages, as we have seen during this presentation, very significant advantages. They can work very, very well, but you need to understand on the front end how these plans work and what you need to be prepared for and to plan for that. And so before you actually sign on the dotted line with an ESOP, you want to have an expert that actually goes through these feasibility considerations for you and make sure that everything works. So you want to ensure its workability and understand the implications and the company's obligations. Is the company a good candidate? You really need probably at least 40 to 50 participants, plan participants to actually make this, make something like this work. You need to have discussions with lenders. Can you find a lender who will, lend money to actually to the ESOP or to the company with a mirror loan back to the ESOP? Can you find a lender who will give you good terms on such a transaction? Can you service the debt? I mean, there is, on the front end, if you have an exempt loan, you incur liability, you have to make sure that you have the liquidity to actually service that debt over time. Deductibility and or the 415 maximum annual allocation constraints. You want to make sure that that all works, in consideration of the payment terms of the loan. And of course, 409P, if it's an S corporation, an absolute must before you go down this road if you are an S corporation. And then can you manage the repurchase liability? The repurchase liability, again, most ESOPs are closely held, comprise closely held stock. When participants are entitled and elect to receive a distribution, that stock needs to be repurchased. And it can be repurchased either through cash balances within the ESOP itself, if you're building up cash along with stock allocations. So when somebody leaves, the remaining participants in the plan with their cash balances could buy your stock so you could meet the repurchase liability that way. Or alternatively, the company is going to have to buy back that stock. So it's important, to consider that and, to adequately prepare for that emerging liability over time. Typically with these ESOPs, we like to do a 10-year projection for every year. And in fact, the valuation people who value the stock each year and accountants, they're going to look for this. They want to know what is this emerging liability, because it has an impact on the value of the stock each year. Moving on to the next screen. The variables affecting repurchase liability or liquidity. So this is oftentimes a complicated analysis because there are a lot of variables associated with, well, when is that liability going to be recognized by the company? So, or when will they have to recognize that liability? So certainly turnover is a big one, right? Because when people terminate, that starts the clock ticking. And so at some point, that stock of terminated employees is going to have to be repurchased. The employee growth. I mean, what kind of growth do you anticipate? Because that's going to have an impact on, how the stock is allocated, as well as, salary increases. Same thing. I mean, who is the stock being allocated to over time or each year? Because that's going to factor into the ultimate liability or repurchase liability when those participants elect to receive a distribution. Vesting schedule, of course. I mean, if you're not vested, then there is no liability or immediate liability. Death and disability, those are often hard to quantify, but if you have a large ESOP, you probably want to factor in some sort of assumption on that, those possibilities as well. The terms of any ESOP loan, diversification requirements, because again, if somebody's eligible to diversify, they don't have to avail themselves of that. So you have to make an assumption on, well, of those people that are eligible, what percentage might elect to diversify. A huge one is stock price fluctuation. I mean, if you've got a rapidly increasing stock price, your repurchase liability, is going to be going up, in a similar fashion. So you need to plan for that. And the retirement age. So those are just, several things that need to be considered. But again, all this is handled by, your advisors and your consultants, so that it can be managed. Next slide. So steps to implementing a leveraged ESOP. Certainly you want to establish your team. You want to make sure that you have advisors or experts who have a lot of experience with these types of plans, so they can adequately guide you through the process, allow the plan sponsors to know what to expect, and kind of help them navigate the myriad rules that apply to these plans so they're not overwhelmed. Now, step two is to start, once you have your advisors in place, start having general discussions with potential lenders. If you're looking at, a leveraged transaction, you need, coincident with that step, you need to get an independent appraisal of the stock. So if it's not publicly traded, the stock needs to be valued so you know what you're purchasing. And that stock has to be valued each and every year as well. So you have a valuation person involved in this as well. Big feasibility study and repurchase liability analysis. I can't emphasize that enough. Critical components, before you actually establish the ESOP. Step 5, which is usually coincident with step 4, determination of plan provisions. And you arrange the final financing, establish a trust, draft the plan, and prepare other legal documents, and then set up your record keeping. So moving on from that, and we're getting close to the end. Just questions that you might want to ask. So again, I'm thinking about advisors, that, there's a lot that we covered here. So, it's not that I expect, everything to be understood and to be perfectly clear. But to now, hopefully you have, an understanding or an appreciation of what may be or what is possible. So when you talk to your clients, you may be able to identify a potential candidate. So some questions to kind of ask yourself: is the business a closely held business with older shareholders who are interested in succession planning? Ask them about that. Has the business thought about expanding ownership to its employees, thereby empowering the employees? Are you like, Peninsula newspapers, wanting to maintain the corporate culture? Are you concerned about that? Maybe you can, retain that through an ESOP. Are there limited exit strategies? Some, companies that are ideal candidates because they really, they're not likely to go public. They don't have a lot of other viable alternatives necessarily, or attractive alternatives. Construction companies, architectural companies, engineering companies, manufacturers, retail establishments, or distributors. These are often prime candidates. Have at least 40 to 50 employees. I mean, you have to have, some critical mass there in order to make these the ESOP work and for it to be feasible. Is the company interested in supplementing employees' retirement savings tied to the company's success? So they kind of work hand in hand. Are the employees or recruits asking for additional plan contributions? Could this be used as a recruiting tool to say, hey, yeah, our company is employee owned? That, may be very attractive to possible recruits. And, is the company interested in utilizing such a vehicle to raise tax efficient capital to expand and grow their business? As we saw, they can, through an ESOP, they can raise capital on a very tax advantaged basis. So those are the questions to ask. Go to the last slide. I think, yeah, that's pretty straightforward. If any of these questions is yes, they could be a good candidate. The more affirmative answers you have, the better the candidate. These plans have been around for a while. They are being promoted by the government. Multiple tax and other incentives available to selling shareholders, company sponsors, and employees alike. So, a very interesting area, a lot of attractive benefits, and in the right instance, these can be, incredibly profitable plans. I can give you any number of examples of some of these plans that have created, many of their employees have become millionaires through a plan like this. So a lot of good things, but enter them with caution. So with that having been said, I'm open to questions. I don't know if Savannah or Lauren have questions, or if somebody wants to, need some clarification. we have a few minutes here to address any of those questions or concerns that you might have. So Savannah and Lauren, did we have any questions that came up during the presentation, or was I able to either totally confuse everybody or make everything very clear?
In the chat so far, we just had one question from Diana asking about getting a copy of the slides, and Lauren is going to send out a little summary afterwards. And it looks like right now we have a hand raised here. Let me, you can go ahead and unmute and speak. What's the name there? Ruben Manzano has a question.
Yeah, I had a question on one of the slides.
Yeah.
I was wondering if it could be put back on screen because it would make it clearer.
Yeah, for sure. Go ahead with your question.
It was a slide called S Corp Consideration and Compliance Testing. Maybe like the fourth or fifth slide.
Right. Yeah. Right
yeah,
there.
they were saying S Corp that's wholly owned by an ESOP pays no tax. But then we're talking about these sub-S distributions to shareholders, which and they're issued a K1, which isn't that what they're taxed on?
Yeah. So the outside shareholder.
The connection between why the ESOP would have no tax liability, but shareholders would.
If there are outside shareholders, those, I mean, when an S Corp distribution is made, it is made pro rata because there's only one class of stock within an S Corp. An S Corp can only issue one class of stock. So if there is a distribution or a sub-S distribution made to the outside shareholders that is made so that they can pay their tax because they receive a K1 that discloses the profit on which they owe tax, then that sub-S distribution, whatever that percentage is, has to be allocated pro rata on all shares of stock held by the S Corp. So if the S Corp owns 40 or 50% of the stock, 40 or 50% of the profit is passed through directly to the ESOP, and the ESOP is a tax exempt entity, so there's no tax. If the ESOP owns 100% of the shares, and there's an S Corp distribution, in that case, you're not going to make an S Corp distribution, to outside shareholders to cover their tax liability because there aren't any outside shareholders. But you can still make an S Corp distribution, and it kind of acts like a dividend, and then it's non-taxable because the ESOP will receive a K1, but they're a tax exempt entity, so they don't have to pay tax on that pass-through income or that pass-through profit.
Okay. Looks like we have another question in the chat wondering why does it take 40 to 50 people? What about 25 employees?
You could have 25 employees. Particularly if it's a non-leveraged ESOP. But there has to be, when you have a loan or exempt loan transaction, you're trying to take advantage of 1042 exchange and so forth. You need some critical mass because you need to be able to absorb the transaction or the terms of the transaction. So it just gets a little dicey when you have, fewer employees. You may not be able to actually take full advantage of, what an ESOP can provide. Like for instance, the selling shareholders may not be able to sell as much stock as they might otherwise have wanted to if you only have, 10 or 15 employees. So it's just kind of based on experience, and because of all the different variables, it's harder to implement and to maintain an ESOP if you only have a handful of of participants. It works a lot better if you have, again, at least 30 or so participants. But, as I said initially, I mean, if it's just if you're not contemplating a loan, you don't have some of those factors to take into account. It's just a non-leveraged ESOP. Then it's more viable.
Thank you for answering that. And it looks like Joey Bender has a question for you. Go ahead, Joey. You have to unmute. Perfect.
Okay, thanks. Good job, Leif. Quite honestly, a lot of this is Greek to me. This may be a dumb question, I'm just going to ask it. So, well, I guess a couple of questions. So, you mentioned that this, C Corps seems to be, maybe more advantages. We don't have a ton of that in our book, at least that I'm experienced with. Would this be available? So I'm looking at a group, and this just kind of came to mind. They're LLC. Now they're taxed as an S corp. Would that still be considered an S corp from an ESOP perspective? If they're a limited liability company and they're taxed as an S corp, or would they have to actually be an S corp? That's my ignorance here on that.
Yeah, well, actually, that's not a stupid question. So they're taxed as an S corp, but they're an LLC. Yeah, I'm not sure if they're not organized as a corporation. You're just saying it's for tax purposes. It may not work.
Okay. Yeah, I mean, that's our adoption agreement has that, for our defined contribution plan. It has limited liability company, and then you could be either taxed as a partnership or sole proprietorship or a corporation or an S corp.
Right, but
yeah,
and I think the reason is because if it's taxed like an S corporation, but it doesn't actually hold stock, there is no stock.
Gotcha.
Yeah, and so you have to have stock.
Right, so it's got to be a corporation or an S corporation for this to work. Okay.
Correct.
Thank you.
Any more questions? I don't see anything new in the chat. Feel free to pop anything in there. If you want us to read it aloud, or if you want to read it, you can raise your hand or just come off mute real quick.
Yeah, I just had one question on the put options.
Yeah, let's hear it.
Leif, you mentioned they had 2 periods in which to exercise the put option. If they don't exercise it during those periods, does the company have any obligation to buy back that stock?
No. The short answer to that question is no, they do not. However, if somebody is holding stock of a C corporation and they did not avail themselves of the put option, for either of those or during either of those 2 windows, they could, in theory, try to sell that stock to an outside party. But the company, the sponsor, has the right of first refusal on that stock. So, if you are going to try to sell that stock, you're going to have to present the terms of that deal to the company, and the company has a right to match those same terms. So, again, the short answer to your question is that there is no obligation, but they do retain that right of first refusal.
All right. Anybody else? Questions for Leif? I think you might have answered and explained everything there is to know about ESOPs today, Leif. Thank you.
Okay, well, and if there's further, or if there's still confusion, you certainly have the opportunity, or all these attendees and future listeners, of course, have the opportunity to listen again to the presentation, because I believe it's going to be posted on our website, the Carlson Quinn website, correct?
Correct. Yes, it will. Am I here? Yep, correct. It's going to be posted.
Well, thank you, everyone. I'm here you can certainly contact Carlson Quinn if you have any further questions or possible leads. We're available, ready and willing.
Amazing. And just for everyone joining us today, you can scan the QR code on the screen if you want to go to our LinkedIn. You can follow Carlson Quinn there to stay connected. I believe that is all we have for today. So thank you so much for joining us. Thank you so much, Leif, for presenting. I really enjoyed learning more about ESOPs.
Thank you,
Thanks
everyone.
Thanks a bunch, Leif. Good job.
Yep.
Appreciate it. All right, man.
Take care.